All right, well, the U.S. economy has impressed all year, but the flip side of this success are interest rates that may continue to stay higher for longer. Joining us now to discuss the economic outlook and more is Jonathan Pingle, Chief U.S. Economist at UBS. Jonathan, thanks so much for joining us. Let's take a look back at last week. We had both the jobs report on Friday, and we also had Chair Powell speaking, kind of outlining his view. We had a lot of Fed speak last week. I'm just curious, as we kind of move past that March meeting, we got the 3 rate cuts penciled in. Do you feel like the Fed is still there? Do they want to be there? How are you thinking about kind of all this build up towards June? It just kind of feels like where we'll be for the next 8 weeks.
Yeah, to be honest, that was one of the more remarkable things about Chair Powell's comments last Wednesday. The message, he seemed completely unfazed, referring to a 3-month moving average of non-farm payroll employment of 265,000. And even after the strong employment report on Friday, that average is now 276. So it's not a whole lot different. And on the Wednesday, in his comments, he referred directly back to the March summary of economic projections, which, the median participant had, penciled in 3 rate cuts this year. So it sounds like to the chair, setting aside a lot of the more hawkish rhetoric coming out of the regional Fed presidents, it does sound like to the chair that March SEP is kind of still operable, to use a word that Chair Powell has used before. But I really do think it hinges heavily on the inflation data we're going to get this week. I mean, we can debate whether or not the strength in the employment report is enough to sort of keep rates higher for longer. But I think ultimately, you had a guest on earlier saying the Fed sounds like they would like to cut. I think they would. It's really inflation that's going to determine whether or not they can.
Well, and it struck us today that you had Jamie Dimon in his shareholder letter saying, well, we're prepared for interest rates to be 2% to 8% or even more. I mean, that's a pretty broad range of what they're prepared for. And maybe he's just being Jamie Dimon and being safe and preparing for every eventuality. But the idea that we could see rates not come down, I mean, how likely do you think that? I mean, some of your peers on the street, not many of them, but some of them are saying maybe we won't even get a cut this year.
So first of all, the potential for there's the risks of something happening are pretty and the potential range of potential outcomes here is pretty wide, right? So I think Jamie Dimon, and I think being in a bank, certainly. You want to assess and be prepared for any of these risks. So, it could be that inflation not only proves sticky, but starts to resume increases. I think Chair Powell actually is worried about that risk as well. When you get to July and August, the base effects are going to flip, right? We had very low month-over-month increases in inflation in July and August of last year. You replace those with relatively strong increases, and the year-over-year change is going to start to pick back up as you head into the end of this year. I think that's a scenario that the Fed wants to avoid, and I think that's the kind of scenario that would put rate hikes potentially back on the table at some point. I don't think that's the near-term risk here. I think the risk right now is base effects are going their way. We are expecting a step down in the CPI to be reported on Wednesday. We'll get the full run of PPI, CPI to look at the March PCE inflation data. I think that's really also going to tell us a lot about, are we going to sort of stall at around 2.5% inflation, or is this likely to continue moving lower? I mean, I think we're going to learn a lot, not just in, the over-the-month change in March, but when we look at the components, it'll give us, I think, a much better sense of to go forward.